Sullivan. I'm a former IRS agent and teaching instructor. Welcome to my YouTube video. This is the home of the 5-minute or less video. I should be able to tell you what you need to know within 5 minutes. I worked for IRS for a decade. I've been in private practice for 4 decades. I've been doing this 50 years. I'm a national expert in IRS resolution matters. I've been on all the major TV stations. Matter of fact, in the last 3 months, I've been on five programs on the Venmo and PayPal issue and the hiring of the new agents. People are up in arms about that. Anyway, I have a whole team of former IRS agents. We're available for representation and consultation. You can find me in the description section below. Anyway, today I want to talk to you about a very, very common question I'm asked, being a former agent. Why? What are the audit flags on tax returns? Very, very common question. People always want to know what those flags are. Let me just go over a few of them so you understand. You can find a lot of these really on the internet, but one I want to explain a little more. If you make a lot of money, $200,000-300,000, IRS has certain filters and algorithms that they do go ahead and they look at those returns a little closer. They know there's a good ROI, rate of return, on that. They can make more money going ahead and doing those, so they pay attention to those type of audits. If you're a Schedule C and have business expenses, that's another place that they're going to go ahead and look, and they're going to go ahead and find some things. Things like office in the home, marketing, advertising, meals and entertainment. That Schedule C is just a place that IRS can camp on and just see what's what and what's not. Hobby losses: if you lose money for about 2 or 3 years, good chance IRS is going to pull your return for an audit. Like I said, losing money even consistently, some people lose it 4 or 5 years in a row, and you're really going to have a huge IRS magnifying glass. If you have FBAR, foreign bank accounts, they're going to go ahead and look. But I want to tell you about the number one reason why you're flagged for an audit. It's really important that you understand this. You can go on the internet and find all these things. Your DIF score is number one. Your DIF score is number one. It stands for Discriminatory Index Function, and there's a number that's assigned to every return. So let me tell you how this works. Your tax return goes on to the IRS system and it is scanned. It's scanned by the algorithms that look at your return. They look at where you live, they look at your income, your gross income, your adjusted gross income, and they look and they take every line item that you have and it's put in a computer. So when you're looking at this, you're looking at nothing but numbers. Well, what happens is IRS goes ahead and they run these algorithms compared to the national average. Let's say for meals and entertainment, for instance, the average Schedule C business owner is $3,000. Let's say you got $5,000. Boom, first flag pulls up. Let's say you have travel and expenses for $7,000 and the average is $3,000. Boom, another flag pulls up. So what IRS does, they're not flags per se, but they are actually indicators, number indicators, to show you're falling out of the national average. So IRS may find when they add all these numbers up that you are 90, on let's say a sign score of 90, that IRS has drawn a line and says at 90, we're going to start auditing that return. So IRS is just going to take the compilation of all the line item scores and add them up and find out how close you are to that line that they want to audit. How do they know they want to audit? Well, let me tell you this. IRS has only so many auditors. They only want to take cases where they can have success. So let's just say they have 5,000 auditors in a particular area. They're going to take the 5,000 or 5 or 10,000 tax returns in that area that have the flags or the scores well above that. So in one region of the United States, you may be able to get by. In another region, you may not. It's all about your algorithms and your DIF score. That is the number one reason you're audited. Many times, if you have a high item, a charitable deduction, interest, go ahead and attach that documentation to the back of the return so they can see that. But remember, it's all about national average and where you fit. As you know, hogs get slaughtered and pigs live sometimes. So at the end of the day, if you're a hog, you can depend IRS is going to be on your back. And what is IRS in fact going to do? IRS in fact will send you an audit notice and let you know the areas that they looked at, and they said you're well above. So as long as you keep within the national average, believe it or not, you'll be really good. Just don't get carried away. But if you do get carried away, you got a problem, give us a call. We can deal with your higher numbers and probably get you one of the better results. We can. Remember, just stay within the national. Oh, by the way, you'll never know the actual averages because they don't give them. It's like the secret formula for Coke. IRS keeps those algorithms, those notices, and they keep them very secret. Anyway, if this was helpful to you, give me a subscription. Sorry, got a flu bug. You can find me in the description section below. I appreciate you listening. Don't get flagged.